record on this computer. Okay. So, hello everybody. My name is James. Some of you guys may know me by Hex, and this is essentially going to be a class that focuses on entries. A lot of people have a lot of trouble with entries, especially a lot of new people. Um, that isn't an issue. What is an issue is you not knowing how market structure actually works or functions, right? A lot of you guys use trend lines. A lot of you guys use Fibonacci, other stuff like that. Personally, I don't use any of that. All that I use is Fibonacci, and that's the only thing that I do use out of that list. Okay. Um, so essentially, what I'm going to show you is how to use, first off, how to get your own entries, right? Off of somebody's trade idea, because at the end of the day, it isn't mandatory to take a signal from whatever instructor it may be. Personally, I don't take signals. I use my own, right? Because I know how to trade and I've been doing this for a while now. Okay. A lot of you guys may not, and that is completely okay. But you need to realize your skill level and you need to make sure that you are acting according to your skill level. Okay. Since you are going to be acting according to your skill level, you must, and I emphasize, you must take this slowly and practice on your demo. Okay. If you want to take signals and you want to put it on your live, that's completely fine. But remember that the purpose of this opportunity and the reason why I joined was because I want to teach people how to learn to trade by themselves, right? That is what I want to teach you guys how to do. So as long as you put in the effort, you will be successful, and you show me that you really want to do it, because I will offer one-on-one sessions with you guys. You will need to put in the work and study and backtest as much as I did, okay, to understand these concepts. So the first thing that you guys need to learn is the fact that with every pair, right, with every pair, there is going to be something called daily structure, right? Daily and weekly structure. And both of these structures are essentially, they're very, very essential for people to understand how you trade, right? So for example, let's say somebody wants to give a trade on AUDJPY, right? Whatever the case may be. Doesn't matter what trade it is, doesn't matter what whatever it is. You just need to know that it's a pair, right? So you have this pair and you're saying, hey, so somebody's calling a buy or somebody's calling a sell, whatever the case may be, right? You have to learn to look at a chart and say, okay, this is why I think that this pair is going this way, or the other. Okay. Now, some of you, right? Yeah. So, a lot of people, some of them may be confused on how to do it, and I'm going to clarify a little bit on how you go about starting your analysis. Okay, because a lot of people don't understand how to actually start their analysis. For me, um, having done this a while, for me, the best time frame to start on becomes the weekly. It becomes the weekly. Before you even analyze a pair, you should be looking at its weekly structure. Now, what do I mean by its weekly structure? First off, you have to realize, is it pivoting? Is it going in a certain direction decisively? Is there consolidation? What position is it in, right? Traditionally, a lot of people are taught that that there are only a couple phases of the market. And I'll go to the whiteboard and show this to you guys. Can you guys see the whiteboard? Can everybody see the whiteboard? No? What do you guys see right now? The chart? Okay. Oh, wait. Okay. Yeah, I got it. Let me do it like this. Screen, change window, and it should be this. Can you guys see the whiteboard now? Okay. So traditionally, right, and this is something just to simplify it for a lot of the new people. Traditionally, you are taught that there are a couple phases to the market, right? A lot of people say it's trending. A lot of people say it's consolidating. For me, there are only two phases of the market, and that is contraction and expansion. Okay, and I will show these to you. I will type these out for you guys. Contraction, and then versus expansion. Okay, hold on. Um, what is that? Yes. Okay. Okay. So we have contraction versus expansion, right? And a lot of people think that the only phases to the market are, trending up, an uptrend, consolidation, and a downtrend. They're not. And let me explain to you why. When somebody says that, and I'm a lot of you guys that have been trading for a second with I'm going to rip out your foundations and install new ones. Okay. Just because a trade is following a trend line doesn't mean that that trade is trending. Okay, it is expanding, and let me show you exactly why. There are essentially two phases to this market, and contraction, think of it like a spring. Okay, a spring essentially works like this, right? You wind it up, 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 and then the closer it gets to each other, right? These two phases of the market, the closer it gets to each other, the more energy it has, correct? And when you let go of it, it expands violently, right? So it goes like that. It goes very, very expanded very quickly, right? Price works this exact same way. Price works the exact same way, and I'll explain to you why. So a lot of times, how many times have you guys seen the market do something like this? Like it drops out right here, and then it starts doing this. How many times have you guys seen this happen? And you guys can unmute your mics and say something at this point, by the way. A lot of times. Right. Right. There's a lot of times that this happens. And this is the part that is called contraction, right? Or and I'll get to the definitions later. But this contraction is essentially pushing price so that banks can move the market in their specified order once they collect something called liquidity. Who here knows what who actually moves the market? Who can answer me that? And you guys can unmute your mics. Who can tell me what actually moves the forex market? Right. So the algorithm, but a lot of people don't know exactly what that is. So let me break it down. Essentially, banks move the market, right? Because the foreign exchange market is something known as essentially a liquidity based market. So essentially, the more money you put in, the more impact you have over the market. So obviously, bigger banks, bigger organizations, stuff like J.P. Morgan Chase, Citibank, Bank of China, Mitsubishi Bank, all these other banks, they are going to have a massive impact on the market. So obviously, when you start trading, you end up realizing that the market is actually moved by an external force. It's not just moved by, you buying a soda. It's not just you buying a car or buying a house that evaluates or devaluates the dollar. It's being moved by banks which want to basically abuse this system called the market delivery algorithm, right? And this market delivery algorithm is essentially how the market functions. right? Following all of the laws of supply and demand, following all of the rules that, basic economics teaches, right? So now that you understand who moves the market, I will show you why they move the market. So essentially, you have this contraction phase, right? And this contraction phase is a point where the banks can amass liquidity. Who can tell me what liquidity actually is? Money. Perfect. That is the exact definition of liquidity. Liquidity is money, right? Liquidity is how much money you have available for you to spend, right? So essentially, if banks are trying to collect liquidity, what are they trying to collect? Money. Now, a lot of you guys will look at this position and you'll draw this position, and what will you think? Like, how would you trade this position? You'd usually not trade consolidation, right? That's what you guys were originally taught, right? To not trade consolidation. Oh, it's consolidating, stay out. Oh, it's ranging, stay out, right? Or some people, in worst cases, some people will end up using this as support and resistance. They'll start saying, oh, this is support, this is resistance, when really it's not. And that's how you end up losing trades, by trading this way. Because banks were the ones that put those methods out in the first place. They paint these things because they know exactly how and when to move the market, so that they can essentially draw something out so that the majority, or the retail, right, of traders will end up doing exactly what they want them to do. You'd be surprised how many people actually sell off of this position once it's been hit again, right? So say it gets hit here, they sell it here. Perfect. You do it again. And they dare them, do it again. And they dare them right here, do it again. And their stop losses are all going to get clapped right here, right? So essentially, since a lot of people want to wait for 3 taps of a support line or of a resistance line, whatever you want to call it, they will end up getting destroyed. Why? Let's look at this position again. 1 tap, 2 tap, 3 tap. 4th tap comes in, you want to sell it massively. You tell everybody, oh yeah, this is going to sell, blah, 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 blah. Your stop loss is 50 pips. You just lost 50 pips because the banks know exactly what you're going to do, when you're going to do it, and they just read your mind. So whenever you feel like the banks, like whenever you feel like the market literally just like tapped your stop loss and came back, it did exactly that, because they know exactly where your stop loss was. How do they know that? They know that because banks own brokers. Banks, big banks, own smaller banks. Those smaller banks own brokers. Those brokers know exactly where you have your stop loss placed. That's why it's so important for you to pick your correct broker. And TJ has his preferred broker, which he will send out the link to later. Okay. Moving on from that, going back to the chart, in this phase of contraction, I trade it, but I don't trade it how you would normally think people trade it. Okay. And there's a reason why. There is something, right, known in the markets and in circles of smart money, something called Wyckoff schematics, right? And these Wyckoff schematics, essentially what they do is they try to help you gain a better entry, right, off of accumulated or contracted positions, so that you can get a low drawdown entry into an expansion move. Before we get too much into this, what do you guys think follows a phase of contraction? So let's say, we come back down here, we draw our contraction. What do you think follows this at this point? What would expansion look like? Right. So a lot of times you'll see this happen. Oh, whoops. A lot of times you'll see this happen. Literally in 34 candles, you'll see 70, 80, 90 pips go like that. Okay, this is expansion. This move is expansion. Okay, now this move of expansion can also happen the other way around. Okay, so does everybody understand the difference between expansion and contraction? So this here is contraction, correct? And this here is what? Expansion, right? Easy. You guys understand that? Does everybody follow? Okay. Now let's delete this. Actually, let's go to a new page, and let's do this backward. Okay. Let's say we go up now, right? What is this? Right. Perfect. Perfect answer. Actually, she caught it very, very well on. That was a trick question. Expansion, then contraction. Perfectly said. Expansion, then contraction. Okay? Because that's what happens. What you don't realize is that down here was the original contraction. Boom, 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 boom. It goes back and forth and back and forth and back and forth. The reason why you see quote unquote trends happening is because expansion and contraction, or in this case, I have two names for them in which you will have to memorize, okay? You will have to memorize these names. These are going to help you very, very much, okay? When contraction happens at the bottom, after a downward move, right? So after a downward move, and it starts contracting right here, this is known, and I'll go more into detail in another class, but I'm trying to give you guys the basics. This is known as accumulation. And there are specific phases for accumulation and specific details for accumulation, but I will give you all a resource for that later, okay? Now let's go and let's have the impulse, right? It has the impulse. Now, when you start seeing contraction at a top, and it starts kind of making this kind of slanted position like this, and this also makes like a slanted position like that, right? This is known as distribution. Okay. Now, this position here, known as distribution, is very interesting because in both of these positions, it will try to fake you out. It will try to essentially knock you out of your position. Say you buy right here, it will go up, it will go further than your stop loss. So let's say it goes like this, right? It'll usually do something like this, right? This is called the spring. Okay. And this spring will help you characterize accumulation from distribution. Okay. Same thing here. Right here, it tried to knock you out. This is called the upthrust. Okay. And now the upthrust is essentially the spring for distribution. Okay. Does everybody understand this so far? Any questions? No questions at the moment? Yeah, of course. So essentially, when price goes down, right, and then starts making a bottom, you could say, right, and makes this little spring, comes back up and tests the spring, and it stays above it. This is what I want you guys to realize. This right here. Okay, actually, let me delete that and make that in another color. I want you guys to stay focused to these 2 points. You see how it broke this range, came down, took out buyer's stop losses, right? And now comes back up and holds this position. Okay. I want you guys to memorize this. Same thing happens here. Top position is up here, right? Comes back down, and instead of going back up like a normal uptrend would do, right? It holds this position and it holds it right there. This right here is something called the last point of supply, also known as LPSY, okay? And this right here is going to be very, very important because you will all need to understand that very, very intricately in the future, okay? Let me change the color of this so that you guys aren't confused. Cool. So this right here is the last point of supply. This is the upthrust. You see how the upthrust and the last point of supply are directly under, like the upthrust is above the last point of supply. The upthrust will never be below the last point of supply. And this is going to be your example of the market coming up to its extremes, okay? You guys can go back and rewatch my other video, the extremes theory, right, that I just posted in the chat, so you guys can get a better idea of what I mean by this. But I'm going to continue. So accumulation is when the market heads down and makes a bottom, and that bottom ends up trying to contract, right? And distribution is the twin brother of this phase of the market because the market moves in cycles, right? Starts doing this. Now it goes up and it starts doing that, right? Now, key word here, it must make this rounding motion. If it does not make this rounding motion, it is not accumulation or distribution, because later on if you guys stay with us and learn more later on, you will learn about reaccumulation and redistribution, but that's a completely more advanced topic, okay? So I'm teaching you guys the basics today. So let's go to another page and let's draw up an example. Let's say the market starts making something like this. Yeah. They appear on every single time frame, I kid you not. They appear on the 1 minute. I get entries off of this thing on the 1 minute. I get entries with as small a stop loss as 2-3 pips on these. And they're extremely good. And I'll give a live example here in a second, okay? So here, right here, what do we have? What is the name of this? Contraction, right? Contraction, which phase? It's accumulate. You think it's accumulation? Yeah, phase meaning accumulation or distribution. I mean, look at this. So this is distribution. I'll help you guys out. Right? This is distribution. Why? Some of you may think like, well, it isn't round enough. Well, there isn't really like, you know, like a drawing line or angle that you can have that's considered round enough. But what you can do is use your points. You have the upthrust. How do you know this was the upthrust and not just another point in the uptrend? Well, because this point right here held it. And now they are at odds with each other. This one held as well, right? When this one holds, that is when you want to enter, right? Usually then or on the retest, okay? Usually is when you want to enter, okay? So this right here is contraction phase distribution. What is this? Expansion. Perfect. Now, what is this? This bottom piece? Right. So it'd be contraction phase accumulation. Perfect. Right.
Accumulation on an upthrust and distribution indicates a downthrust or?
Yes. Perfect. I actually had never shown that part of distribution, but you're correct. Distribution will always lead into a downtrend, which will in turn lead back into what? What do you guys think this leads back into? So if the market moves in cycles, right? And we just had distribution into an expansion, what will this expansion lead to if accumulation leads to distribution? Contraction phase what? Accumulation. Perfect. I love it. Perfect. Perfect, perfect, perfect. Now, does everybody understand this concept? Because I'm about to go into a live example. Perfect. Let me switch screens really quickly. And now I'm guessing you guys can't see anything, so I'm going to switch it out really quickly, changing windows into EGJPY. Actually, I think this should work. What do you guys see now? Okay, let's forget about AEDJPY. That was a different example. So I'm going to go back and revisit this example because I just did it on my other video, but I'm going to revisit it for you guys. Now this is a bit more of a weird example because it's actually in a separate phase that I haven't taught you guys yet, but I'm pretty sure you guys will understand this as it is. So let's pretend this side of the map doesn't exist. Let's pretend this suddenly ceases to exist and we can no longer see it, okay? Now, what does this look like?
Contraction.
Contraction phase. Why does this look like accumulation to you guys?
It looks like distribution. Yeah, I see that.
Right? Now, let's look at it from a little bit of a different angle, okay? We see the upthrust here after the fact, but why do we realize that this is the peak or the upthrust?
Because it's not followed higher afterwards.
It's not followed by a high, but rather respected here, right? And here we also see an order block for my more advanced traders or people who have watched my live sessions before, right? But for you guys that haven't, I'm not going to go into it. I'm going to teach you guys basic market structure before I go into those, okay? So it's followed by a low, right? And this low is very, very easy to spot. Now, there is no reason for you to be trying to catch these reversals. You should be trading once you see the actual schematic, okay? You should be trading what you see. Trade only what you see. You should never be trading what others see or what you think you see or what you want to see. Much worse, right? You should never trade what you want to see. You want to trade what you do see at the current moment. If we use the replay tool on TradingView, okay, and we go here at this point, we end up seeing that this position was held, okay? What can you infer about this position? Now, this is on the weekly, but think if it was on the 4-hour. What would you expect out of this position now that you have started to see this divergence right here? You're going to wait because you want to see its confirmation and whether or not it actually holds its test into a last point of supply, right? So I'm actually going to bring out the labels for you guys. So this is going to be the UTAD or up thrust after distribution, okay? Distribution, okay? Which is then followed by the test. The test is the second most important phase. okay? Because the test will essentially, you want to watch the test. You want to see it. You want to observe it, okay? And then the last one, what do you think the last phase is going to be?
Point of supply.
The last point of supply. Perfect. Okay, so let's advance time a little bit. You're going to wait, or you could have just gone ahead and sold there because, I mean, it's retracing for you. Could have gone ahead and sold. But let's say you want to play it a little bit safer and you don't sell. Perfect. That's fine. Now it paints this position right here, okay? And it returns to its extreme, right? It returns to its extreme, but it hasn't returned up here quite yet. So we want to keep an eye out for that, but essentially you could consider this a last point of supply. Now there can be multiple last points of supply, which would just be re-entries for you, okay? So let's say at this point, right? Let's say that at this candle right here, right? At this candle right here, um, let's say me or somebody else calls a sell, and we called it down here. Why would you not enter that position? Say we call it right here. Well, you wouldn't get into that trade because it hasn't even retraced at all. Right? It hasn't retraced at all. You have to be smart about your positions. You know that the market doesn't move in a straight line. Don't expect it to, okay? If this doesn't move in a straight line, obviously it's going to come back and retest this. It likes to retest its previous highs or its extremes, okay? This is considered as its extreme, okay? Now, this extreme is usually measured by your fib tool. You can use your fib tool, and if it's at least a 30, if it's at least a 38.2, you can mark it as a new extreme, okay? I don't have my 38.2 level here because I don't need it, but it should be somewhere around here, which it is, right? It is a 38, it is a 38.2 level. So you would consider this its extreme. It hasn't touched its extreme yet. Since it hasn't touched its extreme yet, what are you waiting for it to do if I call a sell right here? You say, nope, I'm not entering that, not yet. And if they make money, good for them. But I'm not. I'm gonna be a disciplined trader, and I'm gonna wait. Wait for what? For the retracement back up to the what? Starts with an E. What is this position right here? The extreme. Perfect. Extreme. Wait for retrace. You wait for said retrace, and you are handsomely rewarded for it. Why are you handsomely rewarded for it? Well, because you get a really low drawdown entry. You don't necessarily get a bad drawdown entry. You get an actually pretty good entry. Now, if we were to pretend this was on like the 1 hour, on the 4 hour instead of the weekly, you would get actually a pretty small stop loss. You'd get maybe 15 pips of a stop, right? If you measure out the 50% of this candle, and that's going into further lessons on an order block, but you would get a very, very small stop loss for a very big reward, right? Because it's basically the floor, right? Because this is distribution. Now you've confirmed it as distribution. So you see, when trendline traders are just now waiting for their precious retest, or they're saying, oh, it just broke out, you're already in the trade, even before the breakout. You're in the trade before they even wait for their retest. When they're getting in on their retest, you're already 50 pips in profit. That's the power of trading with smart money and Wyckoff, because these guys, the guys who developed these strategies, literally traded for years. Their whole lives were trading. So learn to listen to the masters, right? Like, for example, Richard D. Wyckoff, he learned from Jesse Livermore and from JP Morgan. JP Morgan bailed out the United States of America at one point. So he's a market maker, if there ever was one. Right? Now, continuing on, Sorry for that sidetrack. Go ahead.
So my experience in trading and stuff is very limited and non-existent in forex. I know that you separated trend traders or like trendline traders versus what we're doing right now. I know trendline traders typically depend on like a multitude of lines to correlate in a certain way to jump in or not. Do we need to be looking at other factors when we look at these accumulations and expanses, or is it just the individual candles?
It's literally just naked price action. You don't need a single indicator. It's just you looking at the candles and where the candles are positioned.
Okay, cool.
That's all it is. You don't need lines. You can use them to help you visualize. Like, for example, I only trade from 7 in the morning Eastern to 11 in the morning Eastern. Okay. So I zone off, right? I draw a vertical line and I draw a vertical line to where I'm going to trade. And that's my start time and my end time. That's all I do. That's all I take from, right? That's all I really abuse. I use them to help me visualize, but I don't use them as a confirmation. Think about it. You think you, as a multi-million dollar organization that is a bank, right? That is a giant bank, right? You think they're going to be using lines to analyze positions like these? Going in the millions of lots? I bet a lot of you haven't even seen the volatility of an 100 lot size. Now imagine a 200 million lot size. That's what banks use. That's a relatively small position for them. They're not going to use those. They're not going to use those strategies. They're going to use strategies that the algorithm uses. They're going to learn to essentially take these positions that the market repeats and repeats and repeats, and they're just going to abuse the hell out of them because they can move the market. Okay. Now going back into this, we waited for the extreme on the retake on the retrace, sorry, and you got a nice entry. Now this is where I'm going to help you guys out, and I'm actually going to use one of your strategies, which is your fib. Now your fib, a lot of times, is going to be used. A lot of people do it from wick to wick. Some people do it from body to body. Some people do it from wick to body. I usually do it from around the point where both candles converge, meaning right around this area to this area, right here. You see how these two candles converge? That's generally where I'm going to put them. And I end it on the wick. Okay. Now I have a kill zone that I'm going to share specifically with you guys. And this is because y'all are family now, right? And essentially what it is, it's the 79 fib level to the 888, 0.886 fib level. Okay. Now, when we draw a little area around that position, usually what I like to do is I like to set my alert from trading because I have TradingView Premium. I set my alert right here on the 705 level so that when price approaches it, I can sit down, I can look at my chart and watch how it reacts, right? Now, when it actually hits this 79.886 level, that is where I'm going to be wanting to enter for a sell or a buy, wherever, whatever the case may be. Who here knows how to use their fib? Still ish? Okay. So I'm going to give you guys like a small little crash course, okay? Just so you guys are all on the same page. Essentially, your fib is meant as a retracing tool to basically indicate extremes. For me, I use it to indicate extremes. I don't use it to indicate 61.8 golden zone magical number retracements. Okay, to me that's useless to me, right? To other people it may work, but not to me. So essentially, what happens is, say you have this swing position right here, and I'm going to call it swing because that's essentially what it is, right? And it goes down, right? Now, when it goes down and it starts retracing up, and let's say the market is in a downtrend, right? Essentially, this is known as your swing high up top here. This down low is known as your swing low. So how you're going to fib this is essentially you take your fib, you place it, if it's going down, right, it follows the trend. So you drag it along with the trend. You click it, right, on the swing high, and you fib it to your swing low. This is how you want it to look, okay? This is how you want it to look. Because at this point, you're going to be seeing how hard of a retracement or how extreme of a retracement you will usually have. For it to be an actual and quote unquote true retracement, you will never pass the 1 or the 1.1 level. Sometimes you see it break a little bit above the 1 and continue on, but you will never pass the 1.1 level if it is considered a true retracement, okay? Essentially that it's valid. You know you're right because it doesn't pass that level, right? Now, our kill zone, a lot of people use the 61.8. I don't even have the 61.8 here, as you guys can see. I only have the 50, and that's because of another reason. It's not even because of the 50 level, right? Delete the 61.8. You don't need it. It's not a thing, okay? What is a thing is extremes. And the extremes happen to be placed at the 886 and the 79, and between the 886 and the 79 level most commonly. So essentially how you would do it is you would, like, if you want a very, very simple explanation, you could put your entry at the 79 and you're still, whoops, that's the wrong way. You could essentially just place your position, your sell position on the 79, right? Where you could have a limit at your 79, and you can have your stop loss at the 1 or a little bit behind the 1, okay? And then your take profit would be the 0, and then all of these other extensions down here would be your additional take profits, okay? Those would be your additional take profits. Now I'm going to put these up for you guys to copy. So go ahead and take a screenshot of this, and you guys can adapt your own trading view fib levels to these, and you'll have my exact fib. Everybody have them? All right, cool. So now when you take this level, right, and you actually end up realizing how strong this is, you end up realizing something. A lot of times you could even put your stop loss behind the 886, or if price doesn't stop at the 79, you could watch for your entry, and a lot of times it's by the 886, and look how small that stop loss is. Well, you know, we're on the weekly chart, but 7 pips, you could, like, so this is 74 pips actually, but imagine if this was on like the 1 hour chart or the 3 hour chart, or, you know, the 3-minute chart. 7 pips, 3 pips, 2 pips, 3 pips, 1 pip. I've seen that before, right? That's how small stop losses become your friend, because risk, and I want you all to write this down, risk to reward is everything in trading. Don't think about how many pips you're going to make. Don't think about how much money this lot size is going to make you. Think about your risk to your reward. How much am I risking for this trade? How much can I lose on this trade? When you think, how much can I lose on this trade, you will end up winning. You know why? Because at the end of the day, if you end up using 3 pip stop losses, say, I'm going to put, you know, like a mean example, right? Say you have a $100 account, right? That is to banks, like to big, large entities, that's pathetic, right? To them, they're dealing in the millions of lot sizes. You're dealing with a 0.01, right? But what if your stop loss was 3 pips? And it's followed by structure that has been proven time and time again since the 1890s. What if your stop loss was 1 pip? What was the last thing you heard, bro? Hello? Yeah, what was the last thing you heard? Right. So essentially, let's say you have an $100 account, right? To the banks, it's pathetic, but to you, that may be the only thing you have, right? What lot size would you place if your trade had only a 3 pip stop loss? Be honest, all of you. A 1.0, a 10, a 20, a 50? Well, that's how I flip my accounts. That's how I took accounts from $500 to in the thousands. Because once you end up mastering risk to reward, you're going to be successful. Okay. The key is not how many pips you catch a day. It's the smaller the stop loss, the heavier the weight or the heavier the lot, right? Now, do you guys understand how to use your fib? Because that's going to be very, very, very important for this next section. I would rather you stop me now and me have to explain it again than you trying to do this on your live account and you losing money. Okay, no problem. Let's go ahead and do it again. Why not? Yeah, let's go ahead and do it again. No problem. Okay, so let's say you're in a downtrend, right? And I'll do two separate examples. I'll do a downtrend and an uptrend so you guys see how you do it. Okay, say you're in a downtrend or not even a downtrend. Say right here, right? You see how the upthrust after distribution, this little peak came back after and it was respected by the test, right? Now that it was respected by the test, this can be considered a break of bullish structure, okay? Let's say bullish structure breaks. And now you're stuck with a high that goes into a low and is starting to retrace. This up here is called the swing high, okay? And this below is called the swing low, okay? The swing high and the swing low are the two important parts that you're going to need to learn to actually spot, okay? Now, out of these swing highs and swing lows, you're going to take your fib retracement tool and you're going to place it at the top, okay? Because you're trying to essentially, like, basically what this tool essentially does is say, hey, how far will this retrace to for it to keep going in its direction? Now, again, for you guys that are not aware, I have a theory called the extremes theory. And the extremes theory is basically saying that the market moves in extremes. The market either goes back and retests these highs, or it just straight drops off into a different, universe. Okay. So the extremes is basically there is no in the middle. There is no in the middle. There is either the extreme or there is a drop off. Okay. So now we take our fib retracement tool and we place it at the top. Okay. Your 1 should always be at the top. Your 0 should always be pointing in the direction that you want the trade to go. Okay. So we click it, we drag it, and then we place it. We end up placing it, right? The last line, the 0, you guys see the 0 that I'm dragging around? Should be placed at the swing low. Now, some people like to do it from the body of a candle to the end of the wick. I just say do what fits for you. You'll end up finding it by experience, okay? Now, my kill zone is not what other people teach you at the 61.8, 69, 68, whatever. Sorry, 62, my fault. I don't trade that way. As you guys can see, I don't have the 27, the 38, I don't have the 60. I don't have any of those levels. I just care about these because these are the extremes, okay? And I care about these because they are the extremes as well, okay? So now my kill zone is the 886 and the 79. This area right here is my kill zone. That area right there is what I am most concerned with every single trade that I take. Okay, the 88.6 will become your best friend. Essentially, what price will usually end up doing is it will end up retracing to this extreme and it will actually come back up, wick the 88.6 or the 79, and then it will violently reject off. And by the time that your peers are looking for entries and looking for more confirmation, you're already 70 pips deep in a trade. Okay. And you will learn this by experience. And if you guys are in Giselle's team, I will teach you personally. Okay. And if you guys are interested, text me after. So what we do here is essentially we look for this deep retracement and we end up taking that trade with our stop loss up at the 1, right? So we put our entry either at the 79 or at the 886, whatever the case may be, whatever the entry is most relevant at, right? The 886 or the 79. And then our take profit 1 is at the 0. Now, the rest of these little lines over here are something called Fibonacci extensions. And these extensions are essentially usually how far the trade will go in the long run. So those are going to be your extended take profits, okay? So every single one of these lines after the 0 is going to be another take profit, okay? That's essentially how you do it. Does everybody understand this? Yeah, we've had those hit before. Yep. You remember that GU example that I did, that the first class that I ever did with your team, TJ? That hit the 2. That was the last take profit, and it hit. Yep. Exactly. You could have caught every single one of those pips. So now let's take a look at it from an up position, right? So let's say the position is going this way. Where would you place your fib? At the bottom. And where are you going to swing it to? Swing low to swing high. Yeah, it's just vice versa. And the same thing happens here. Where is our kill zone? Perfect. 79 and the 886. And now your long position, depending on where your entry is, can be as small as this. Your stop loss is where? Just behind the what? Mm-hmm. Where's your first take profit? The well, no. The just behind the 1 is the stop loss, and the take profit 1 is the 0. And what is the negative 27? TP2, TP3, TP4, TP5, TP70, right? Whatever you want it to be. Okay? That's essentially how you use your Fibonacci.
I was gonna ask, how fast should it hit the 0.79 and 0.886 zone before you kind of know it's gonna retrace?
So that's where lower time frame confluence comes in, and essentially what that is you look at lower time frames to see rejection, sometimes even as small as the second time frame. But that is a very advanced concept. A lot of times what you'll end up seeing is you'll end up seeing it wick the 886, like literally it'll tap it and then drop violently. So that's where the candles that look like this come from. That look like, there's a massive wick, and then there's like that. You know these candles where it like wicks right up here and then like it goes down.
Yeah, that's a sign of rejection, right?
That's a complete sign of rejection. But a lot of retail traders are looking for confirmation after the candle closes, which by then you've already missed this whole move. But with the strategy that I just taught you, you're getting entry right here. You're getting entry right here. You're getting entry right here. You're getting entry right there. Sometimes you're so accurate that spread misses. Literally, spread will keep you out of the trade. One time I had a you guys remember like a week ago or 2 weeks ago that giant move on gold where it started like shooting down? Yeah. So I had an entry on gold that literally caught the peak, and it missed by spread. It missed by literally 2-3 pips. and I had a 0.75 lot size on it with like a 4 pip stop loss. And I literally just kind of like I was on a call with one of my other guys that I trade with, and I just kind of looked at him and I was just like, I quit. I shut my laptop and I didn't trade the rest of the day because I was so mad, because you know what you're doing and you know you got it right, but you get so accurate that spread misses. So you have to account for spread with this, okay? Spread. So has your mentor taught you the difference between the bid and the ask line?
The blue and the red lines are meditated for the different prices, but when you enter the position, you automatically start at negative.
Wow. Okay. So essentially on MetaTrader, right, there are two different prices. There's the bid and the ask. Okay. I forget which one is which, but essentially, if you are trying to sell, right, if you're trying to sell a position like this, right, um, the broker is actually going to start you here. The broker is going to enter you on the bottom line. If you're trying to buy, the broker will actually start you on the bottom line. Why? Because it. Oh no, I think that's backward. Is it backward? Let me check for a second. Let me give me 1 second so I don't like misinform you completely, because I don't. The colors are tripping me up. Yeah. So if you're trying to buy, it opens you at the top line, and actual price is at the bottom line. So it starts you off like this. Like, say you enter now, right? Your broker is going to end up opening your position right on the red line. It's going to open it on the red line so that you are immediately negative. This is something called spread. The spread between these two lines is the spread. And your broker will immediately count you as negative because the blue line has not overtaken your entry point yet. Does that make sense? So if you're trying to buy, the broker is going to open you higher, so that price will actually have to come up these, say, like 7 pips or 8 pips or whatever pips up before you're actually blue. So not only that, but you're also going to have to cover your own spread fee. So by the time you're in profit, you're like all the way up here. Right? And that's a very slick trick that all brokers use to gain money. Because if you're over leveraged, it might kick you out right there. Now, say you're selling, right? If you're selling, the exact opposite thing. It will start you lower. So it'll start you here, so that this actual price has to overtake this, your entry point, and your spread fee has to be covered before you're in profit.
Okay.
That makes sense?
Yeah. I think you're gonna have to like show me on MetaTrader, but I get what you're saying.
Okay. Yeah, I'll show you. I'll send you a picture. Send me a text. Yeah. So let's keep looking at. So everybody understands your fibs, correct? Everybody? Cool. And if not, you're gonna have to rewatch the video once I post it. So again, this position just wicked off of our 79, 886, and we got our entry, right? Now let's place our position here. We see it keep going, and it hits the 886. Perfect. You're either going to watch for rejection at the 79, or you're going to wait for the 886 to get hit. Okay? So you have your short position at the 886. Your stop loss is at the 1, which is right above those wicks, coincidentally.
So stop loss is always at the 1, right?
At the 1 or a little bit above it, or usually above wicks. Above liquidity is what it's called.
Okay.
Yeah. And your first take profit is at the 0. or it can be at the negative 27, right? Wherever the case may be. You essentially take partials at the 0 and you leave your take profit open, okay, after that. Okay, so let's say we go for TP3, right? Look at the risk to reward ratio, 11-1. What are you guys usually used to seeing on your risk to reward ratio? 1-2, 1-1, negative?
Yeah.
1-2, or 1-1. At that point, you're just kind of guessing where the market's going. But again, what did I just say? That what is king in the market? Risk to reward is king in the market. Because I, here in this position, can drop a standard on a $500 account and not feel a thing. Why? Because I'm only paying the swap and like 4 pips of drawdown if it hits stop loss. But if it hits take profit, oh my goodness. Right? Does that not wow you guys?
That's crazy.
Wow, I'm wild.
But that's exactly how you trade. That's how you trade properly.
I'm about to hit US 30 tomorrow, man.
Now, let's watch how price reacts here, okay? This position was already hit TP, so we can mark that as a win, okay? We already marked that as a win. Cool. Now let's watch for our next entry. It already started to retrace. So where would you place your fib from? You could place it from up here.
Swing high to low.
You could place it from up here again as well. Could do that. You could also put another swing, right? You could also put another fib from up here to down here. So now where are you looking for? Around this position right there, right? Now, let's watch what price does. Ooh, perfect. Now, this is something that you guys are going to need to learn. Where was stop loss hit? If you would have fibbed it from where? From here, right? If you would have fibbed it from there, your stop loss would have gotten hit. Barely, but it wouldn't gotten hit. You would have gotten wicked out by like a pip, right? That's why you put it slightly above the 1. But let's say for fairness sake, you get stopped out. Why was the proper fib up here and not here?
Imbalance.
Imbalance actually is a good answer. Yeah, but in a more simple term, why was the fib here and not here?
It's an impulse candle. I don't know.
So this position right here still holds the dominant position because it was right. So I kind of coined this term. I don't know if it's been used before, but it's essentially a hierarchy of price, right? You always, after the LPSY gets mitigated, usually what ends up happening is it returns to that position, mitigates again to, again, stop out people that have buy stops, stop out people that are trying to sell it or trying to trend line trade, right? Because let's trend line it. Let's go back to our retail origins that I never want to go back to, and let's trend line this. Wow, you got stopped and you like no confirmation, no entry, right? Boom, and you missed the move. Retail loses again. Now the LPSY usually always gets retested. What ends up happening here? You end up getting retested and you do not get stopped out. You could have entered right at the 886, stop loss a little bit above the 1, take profit at the 0, and look at that magic. This is where your trading psychology comes in. A lot of people see this and they're like, oh my goodness, it's going to hit stop loss, and then it doesn't hit stop loss. You will not believe how many times stop loss has come within spread of my stop loss and gone back the other way. Rarely does price hit your stop loss and just keep going. Because by this point, price has already made its intention pretty clear. It says, I'm going to go down, whether you like it or not. I'm going to go down, right? So in this case, you wanted to keep this position open and you wanted to say, hey, I kept this position open. Even if I lose, I still have this other higher position where I could again enter, right? But since you have such a small stop loss, you have that luxury. Imagine if you had a massive stop loss. You already sustained a massive loss because you didn't enter correctly, right? You had a big stop loss. So it hits it, and now your account is crying. You're crying. And the trade goes right back your way after it hits your second, and this is a more advanced technical term, but after it hits your second POI, it ends up going your way. And now you're just confused as to why the hell you can't win. It's because your trading psychology is out of whack, okay? So, and look at this. Look at this. This is actually another point that I want to make to you guys. Whenever price closes with this kind of candle, a lot of times, price doesn't have to do it immediately, but you generally know where the market is pointing you toward. Because essentially the market will do that and come back down, or it'll straight up just go down, right? It loves to fill those wicks. It loves to fill those wicks. So essentially in this case, doesn't need to come back again at that point, but look at where it's going to come back to. Now, here's a pretty interesting thing that I think a lot of you may have realized. What did we get here again?
We got a retest at the entry. So.
Not only that, you got a second entry. You got another entry. You already took your profit here, 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 and here, and you get another entry. Seems pretty good, right? Again, retesting extremes. This is where my theory again is proven. Extreme, extreme, retesting extreme, reaction off of the extreme. Cool? Now here you could have gotten another entry. And again, it starts retracing. Here's the perfect entry. Why do you guys think you would have gone in at that position, or you could have gone in at maybe a little bit higher of a position? Why do you think this position would be something that you would be interested in, even after this massive position came back up? You have previous structure there, right? Not only do you have previous structure there, but you also have this dominant position on the LPSY, right? The hierarchy of price, essentially saying the structure of the LPSY is going to dominate everything else. So if all else fails, go back to the structure of the LPSY, okay? So if you would have said, hey, let me fib it from here to down here, what would you have seen? 886, you would have gotten a wick entry. And not only that, to all of my more advanced smart money traders, what is this? I don't know if there is any. Mitigation. And what else? What is within this in lower time frames? Lower time frame inefficiency getting mitigated, right? Distribution, right? Oh, you said it the first time. Yeah, never mind. My fault. But yeah, essentially, to everybody that's a little bit more advanced, these wicks, you can find your entry right here if you go on the lower time frame. If you would have gone onto the 3-minute, you would have found distribution there. And I went over this in my extremes class. So if you guys want to look at the perfect, and I also posted this on my Instagram. So if you guys want to go look at that, you can go look at this. This is just one of the most perfect examples I've ever seen.
You made it look very simple, and with the field, it made it a lot simpler for beginners as well.
A lot of things end up correlating to each other, man. So once you find one thing, you can kind of find the rest. And it isn't simple. It just takes a lot of practice. And once you get Like, that's why I'm here. That's why other instructors are here. As long as you trust them and they prove to you that they know what they're doing, you will be profitable. Okay. There's no reason for you to be selling a trend line or buying a trend line. If they use concepts that make sense and that are proven, you will be profitable. Now here you have a very small stop loss. You have a 6, almost a 7 risk to reward ratio. If you would have caught it all the way to the down part, you would have almost had an 8 risk to reward ratio. Okay. Now, if you would have used your lower time frames and gotten this, you would have had a 13 risk to reward ratio. Imagine that. Imagine if you had let's say a 6 pip stop loss, a 7 pip stop loss for an 100 pip TP. What lot would you place?
My house. Yeah, I'm thinking about my mama's life saving.
Your 401k.
I might think about it.
Right, exactly. But why are you so confident about this trade? Because of the fact
You said that my odds going down, and the 150 going up.
your risk to reward ratio, you lose virtually nothing. You lose the same amount as your other peers on other places, right? That are buying off of trend lines and buying off of whack patterns, and they're saying, oh, a 50 pip stop loss is okay. Their stop loss gets hit. They're losing the exact no. So look, they just lost 50 pips, quote unquote, properly leveraged, right? You lost 6 pips properly leveraged because you lose the exact same thing, but you gain like 50 times more because they get their take profit hit, they get $100. You get your profit hit, you get 3 bands. That's just how it works. Really. I dare, and this is going to be your homework, because for all of you guys that just saw me come in, I'm Hex, by the way, for you guys that don't know me. I just signed up today, okay? That's why. Shout out to Giselle and to TJ and to Cam and Eric, all of them.
He just joined today. Hey, just stay calm.
So essentially, what I want you guys to do, and I'm gonna be assigning homework to you guys, because I know that a lot of people ICT stuff that know their Wyckoff stuff, they're gonna be like, yeah, I know this works. Thank you for sharing. But do it, back test it, do it more, refine your sniping skill until you literally catch the very top pixel of that candle, and you know exactly why you hit it. Okay. For all of you guys that are more beginners, practice using your fib. Again, if you guys don't have my settings, here are my settings again. Practice using them. Practice using them. Most importantly, the 886 and the 79. Okay. Next class, I'm going to show you guys what an order block and institutional order flow is. Okay. Notice that I never once mentioned trend line, support and resistance, supply and demand, and you guys are already better traders because of it. Those are fake. I'm sorry to say it. They are fake. They are not real. They are a myth. They are things that have been conjectured by people, and they think because it works 1, 2, 3 times, it works. Something that works every single time is what works. If your car only starts 5 out of 10 times, is that a good car? No, you're going to take it straight to the mechanic. If your strategy works 9 out of 10 times, and that one other time is because you put your stop loss a little bit too tight, or you got a little bit overconfident or trigger happy and you decided to pull out before the trade actually went your way, or say you misread something, you didn't go deeper into the time frames and you missed it, or you missed it completely, like you didn't see the trade at all, you were asleep or whatever, right? We all have needs. You're going to get to the point where trading becomes second nature, to the point where you glance at a chart and you know exactly where it's going, because it becomes second nature once you practice. It's the same thing as boxing. It's the same thing as soccer. It's the same thing as football. It's the same thing as writing. If you guys show me that you have the dedication, that you guys want to do it, I will take time out of my day and have a one-on-one class with you. But you have to show that you want to do it, because I have like 15, 16 more students that want one-on-one times. And I will make time for all of you as long as you take time out of your day, study the resources that I'm going to give all of you. Okay? So that's going to be your homework. Your homework is abuse the 886, abuse the 79, abuse the 1, abuse your small stop losses. Go lower into time frames. Say this was the 1 hour, right? Say this was the 1 hour. Go into the 5 minute, go into the 3 minute, go into whatever lower time frame you want to go into. And a lot of you trade HFX. I personally have never traded HFX, but considering what I already do, I could just use daily structure, go down to the 1 minute, and snipe an option from like now to like 5 hours from now, and end up with a ton of money, just because I know where price is going in the general direction. Not only in the general direction, but I can call it from when I see it. So on the 1 minute time frame, and I'm gonna go ahead and exit this this replay mode. As you guys can see, it went all the way down, hit your take profit, and now it's retracing again, coming back up to the extremes, right? Coming back up to the extremes. If you would have fibbed it from here to here, you would have gotten another entry off of your 886 and is falling. However, make sure to be aware that it has now not continued bearish structure. Be aware of this, okay? That's all. However, as I was saying, for everybody that that is new, practice on using your fibs. Practice, go ahead and back test, okay? And I'm going to get rid of all my drawings here. Go ahead and back test. Literally, who knows what back testing even is? Let me get like a show of hands. Who actually knows what back testing even is? Yeah. So essentially, when you have a trading view, I highly suggest you to invest in a laptop or a tablet, whatever. Or if you have a larger phone, like I have a Samsung Galaxy Note 10, I use the pen and I turn it sideways and I backtest on that even when I'm on the road. Okay? Take your replay feature, and now you can click whatever line you want to go to. Sometimes what I do is I just go on the weekly and I just pick whatever, and I'm like, boom. And then from here, you can move the time frame. So from here, you can say, okay, I'm going to move the time frame down to the 4 hour, the 2 hour. I love the 2 hour time frame. I suggest you guys get on that. The 2 hour time frame. Let's say we go back up there, and then we say 20-minute time frame. I love the 20-minute time frame. What do I see here? What do I see here? Distribution, right? Distribution up here on lower time frames. If we would go to the 1 minute, this would be perfect distribution, right? Now, what do we see here? Bearish structure, sign of weaknesses, right? Signs of weakness. Now, what happens? Let's fib it. Fib it. Oh, what is that? What is that? No, not only that. It's their first entry, but 11 pip stop loss for a take profit 1 of 85 pips. A take profit, the last thing for like whatever pips you want to go for. But let's go all the way down, and it hits your 2 for 279 pips. Now, it took a while. It took like what, like from September, 3rd of September to 8th. Oh, wow. It only took a couple days. 279 pips. And you could have left your take profit open and it would have kept going for a total of what? For a total of 451 pips. for a total of 451 pips.
You were to go.
And how many pips did you risk? Did you risk 50? Did you risk 100? Did you risk 80? You risked 11 pips. And you could have made it smaller if you guys were a little bit more advanced. Could have targeted the lower time frame inefficiency. And you would have gotten a 3-pip stop loss for 450 pips?
Hey, are you aware of what gold gap is?
About what?
Gold gap. Did you ever hear about what happened with the glitch and when the broke people play called gold gap?
Oh, yeah. So actually, Hugo's way. Go ahead and tell me. I didn't hear about this.
Well, you know, like he goes away.
Dude.
There was a gap about almost about a year ago. There's a gap in Hugo's way that gold at the 5 o'clock open it was gapped from like 5:02 to 5:03. So what the gap was basically it allowed you to have a 5 minute gap before it happened, and it was only on the Hugo's way broke. So at 5 o'clock every day when you hop on at 5 o'clock from 5 to like 03, you were able to catch the gap before it even happened. But no, I was just saying that's just kind of like the comparison to do like with those types of stop loss. With a small stop loss, right proposition, is beautiful, bro. But like I said, appreciate it. Go ahead.
Yeah. Yeah. So here's one thing that I have to say about brokers. A lot of you guys use Hugo's way, or KOT. If you do a little bit of research, and I called one of my friends up that works for a bank. He knows about all these brokers and stuff. Um, eh, they're all owned by the same bank. He couldn't tell me what bank it was, but essentially Liquid, Osprey, KOT, and Hugo's. They're all the same. They're owned by the same people. They're managed by the same bank. They're managed by the same subdivision. They're literally the same bank. And that bank is not FCA regulated. It's not FCA regulated or CFA regulated. It's not, which means that they can do with your money whatever the hell they want. Now, one of my friends, when I first started, Jacoby, he ended up getting his account robbed for about $2,000 from Hugo's. And he tried to contact support, and they literally would not answer him. Because that's what unregulated brokers from the CFA, from the FCA, that's what they can do to you. They can do that.
What do you recommend?
Me and TJ have been recommending this broker, Eagle FX. That's our personal broker. That's the one that I've been doing for a while. FPA regulated, FCA is regulating it. It's not CFA regulated, which is the actual U.S. board of regulation, but it is regulated by a separate entity. And it's very simple. It's very anonymous. They ask for KYC, but it's not needed if you don't want to, because of their anonymity clause, whatever however you pronounce it. And if you guys also have downlines, it's a good way to also make a little bit of side income, because once they sign up under you, you make money off of all the trades that they take. Because they pay you back the commission that they take. So you guys know how you guys like take like 6 cents off, 12 cents off.
Yeah, just click the link that I sent in the chat, and then make an account, and then they're gonna give you away. And as long as you use that broker, you give it to all your people instead of KOT, who takes the fees and commission from us and puts it into their own pocket. Eagle FX, what they do is while they take the same commission and fees per trade, they give a percentage of it back.
Yeah, they give it a percentage back to the person that referred you. So yeah, guys, does everybody remember their homework?
Yes, abuse.
abuse the fib, the 886 to 79. Please, even though it seems easy, and you may just want to stick with the fib, please, I beg you, practice your Wyckoff schematics. Practice spotting accumulation. Practice spotting distribution. Practice spotting contraction, expansion, contraction, expansion, and backtest. What do I mean by backtest? Again, guys, literally just go on the weekly or whatever time frame, swing back, use the replay feature, and start practicing.
That's a big nugget. That replay feature is a big nugget. I'm telling y'all that is mad sauce right now. I literally have Wyckoff printed out on my wall. I would advise y'all to do the same. Go ahead and print out that Wyckoff method. There's two different styles with distribution and accumulation. You can place it on your wall, either exact or form. That's what I did. So I found out about it, and it helps you really identify that a lot easier. So I'm telling y'all, this is mad game.
You know what, guys? Because I feel very happy today. I'm going to give you guys the actual website that I used to learn this a while back. Literally, it's a tutorial of how to use the Wyckoff method. Literally, just type in Wyckoff schematics to Google and click the first link that is school.stockcharts. Literally, boom, there you go. And I will send this out to the chat to you guys. Let me see if I can actually have it. I don't know how to get this down. Oh, whoops. That's not what I wanted. I'll send it to you guys later, but it's fine. But yeah, essentially, you guys can go down here and you guys can essentially say, hey, Wyckoff price cycle. You guys will learn everything. You can skip this top part until the actual like accumulation schematic, distribution schematic, and it gives you two different schematics that you guys will need to learn. But also look at this. It explains every single phase. So make sure you guys abuse the hell out of this and read it. Okay, read it, study it, take notes. And you know what? At the end of the day, this is a business, right? So take snippets out of this video and show everybody else that you are not just somebody trying to get a sign up, that you are somebody that knows what they're talking about and are constantly working to become a better trader. Okay? That is essentially what you're trying to do. So be honest. Say that you are learning to, and say that you can put them on to somebody who has made a lot of money in the market, and they are more than welcome to sit down with them and speak to them individually. Because that's what I'm going to do with all of you guys. I'm going to take time out of my day and I'm going to one-on-one you guys if I see that you guys are actually putting in the work. So you put in the work for me, I put in the work for you, and we grow each other's businesses. Sound good for everybody?
Yes, sir.
All right. And for a lot of you guys that are trying to get into stocks, I made a PDF getting you guys into the beginning of stocks. And those beginnings of stocks will help you guys out massively. I will send it again, and I will ask Giselle to send it out in the bigger Discord. Okay? So I appreciate you guys for coming. This class has gone on a pretty long time. I appreciate all of you guys. If you guys want another one of these classes, please let us know. And if you guys are looking to get started as well, please send me a message, and I will get you started. And you guys are going to be under my personal mentorship. So I'm going to be almost 24/7 on you guys. Okay, so everybody that's with me and Giselle, I'm going to be on your asses. So yeah. I appreciate you guys for coming. Does anybody have any final questions?
I wanted to add one last thing. We still have that $100 giveaway in the chat for everybody that can have 3 days consecutive 15% profit without losing a maximum amount of $250 on the demo account. It doesn't even have to be live. So if you want to get some play around money with your live account, just go ahead and put the work in on your demo.
79. Use the 88. It's very easy. I already did it.
Disqualified, man.
Yeah, I know. But I'm helping all of you guys, okay? use the 79, use the 88, use your distribution, use your accumulation. And I will, after then, show you the rest, which is going to be a lot more stuff. So get ready. It doesn't stop there. All right, guys.